This is a presentation on Chapter 1, Introduction to Managerial Accounting. In Learning Objective 1, we are going to define what managerial accounting is and understand how it is used. So there are basically two types of accounting information. There is managerial accounting, which we're going to start studying now, that focuses on providing information mostly for internal decision makers. And then in Principles 1, we studied financial accounting information, and that focuses mostly on information for external decision makers. Now, managers within a business are going to use both types of information. Managerial accounting is mostly going to be used to make the day-to-day decisions that managers need to make for the business to be successful. But managers also use financial accounting information to report on the monetary transactions of the business and the financial statements that are relevant to both the internal processes but also to external users. So this slide shows the differences between financial and managerial accounting. As we mentioned in the previous slide, most of the users of financial accounting information are going to be external to the business. So these are the investors, the creditors, and governmental authorities. Managerial accounting is only going to be used by the company's managers and their employees, so those that are inside or internal to the company. The purposes of the financial information is to help those external users to make investment and credit decisions, whereas managerial accounting is what managers use to be able to plan, direct, and control their organization. The focus of financial accounting information is on the past. So when we complete an accounting period, we will then use the information to prepare the financial statements. So typically we would report on the activities for the prior year, and that would be reported in the next year. So it's always going to have a dimension of the past, whereas managerial accounting is usually going to focus on what is going on either right now in the business or the future. So that is just a different time dimension. The rules for preparing the financial statements are governed by generally accepted accounting principles in the United States. These principles have to be adhered to by public companies, and their financial statements have to be audited by an independent CPA. And the reason for this is, first of all, financial accounting information is going to be used to compare different companies. So you want to be able to compare companies based on them, on the financial accounting information being prepared using the same principles. Also, because the information is being provided to third parties, outside users, you want that information to be audited because it increases the credibility of the information. Managerial accounting doesn't have to follow these rules, the GAAP, because it's not going to be provided to outsiders. It's only going to be used by the internal users. The scope of the information for the financial accounting is usually going to be a summary of either a month, a quarter, or annually. So it's going to be over a period of time. Whereas managerial accounting may be provided daily or weekly. So it's going to be much more timely, and it's going to have a lot more detail in it than the financial information. So as far as the behavioral consequences of the information, there is always concern about how people will behave based on the financial accounting information, and there are some ramifications of that on management's behavior. But we are more concerned in managerial accounting with how the reports and the information would affect how managers behave. So the managers in the organization are going to occur at all parts of the company. So companies tend to organize their operations around departments, and then those departments belong to divisions. And so in order to be able to understand the relationship between all of the different departments and divisions, organizations will have what we call an organizational chart. And that just shows who the managers are for each of the individual departments and the divisions and who reports to each of these managers. So this is an organizational chart for that fictitious company that we've been using throughout our study of financial accounting, and now we're going to use them in managerial accounting, and that is Smart Touch Learning. If you remember back to Principles 1, Smart Touch Learning started out just providing e-learning services to their clients, but over time they began to purchase tablet computers and sell those along with their e-learning software, so they became a merchandiser. So in the managerial chapters that we are going to be studying, Smart Touch Learning is now deciding to become a manufacturer of the tablet computers. So as part of their strategic planning, they have decided that it is better for their company, in order to be able to maintain their market share, to actually manufacture the tablet computers, because they believe they can manufacture them at a cheaper price than they could buy them. So this chart just shows how Smart Touch Learning is organized. So we see at the very top the board of directors, and then the chief executive officer reports directly to them. Then the chief executive officer would hire the chief financial officer and the chief operating officer. The chief financial officer would be over the controller, who would be involved with the accounting department and be over, say, a payroll processing manager, but that chief financial officer would also be over the treasurer. Then under the chief operating officer would be two division managers, one for manufacturing and selling the tablet computers, and then a software development division manager. So that just shows who reports to which manager and what that manager is responsible for within the Smart Touch Learning organization. So in that organizational chart at the top, we saw the board of directors. So if you remember from financial accounting, the board of directors is elected by the shareholders in order to represent their interest in the operations of the business. So the board of directors is going to be developing those big strategic goals of the corporation. So the very big picture. And as we said before, the board of directors is going to hire that chief operating officer. So the chief operating officer is going to be the highest level executive within the company that's going to be responsible for the vision and the mission of the company, as well as developing those short and long-term plans. So within any company, we can divide up each of the positions. They're either going to be considered to be a line position, and those are going to be the people that are going to be directly involved in the day-to-day operations of providing goods and services to the customers. And then there are going to be staff positions that support the line positions. So your line positions are going to be the people that are actually involved in the manufacturing and also in selling the goods to the customers and providing any kind of customer support or repairs for any of the goods and services that are sold to the customers. Staff positions are going to be people like the accounting department, the IT department, and the human resources department. And all of those are just going to provide those services to the line positions. Managers have three main functions that they perform within a business. The first thing that managers do is they're involved in planning. So it requires the managers to look to the future and establish the goals for the business. So there could be many different goals for a business. So all businesses, of course, want to increase their operating income or to make a profit. But other goals might include things like, do we want to offer a new product to our customers, or do we want to expand our operations into a new territory? So within planning, there are two different types. There is strategic planning, and that's going to be the developing those long-term strategies. So these are going to stretch out usually over 3 to 10 years, and these are going to be the more big goals for the company, like will we want to expand our operations to these new territories, or to add a new product, or maybe even purchase another company as a subsidiary. Operational planning, though, is going to be those short-term things, like how are we going to be able to meet our sales goals within the next week or the month or quarter, and then from those sales goals, how are we going to make sure that we have enough products on hand in order to be able to sell those to the customers that are interested in buying them. Then the directing part of being a manager is those day-to-day operations. So handling all of the issues that come up that are involved in purchasing the materials, manufacturing the product, and selling them. So managers have to make sure, of course, that there's enough materials on hand for manufacturing those products, but also making sure that the employees are showing up on time and that they are performing their duties. So say even if you were like a marketing manager, you're not involved in the manufacturing, but you've got to come up with the marketing plan, train your sales representatives on the sales of, say, a new product that the company might be offering their customers. And then controlling is that process of monitoring the activities of the business to make sure that the company is staying on track. So whatever those operational or strategic plans were, how well are we doing in meeting those goals? So one of the ways that managers can do this is by comparing the actual cost of the business to produce their products with what they expected to or budgeted to produce those products. And by looking at what the budget was and then what the actual results are, the managers can make decisions and modifications or changes in their operations. We saw this Pathways Vision model in Principles 1, and we talked about many people have the incorrect perception of what accounting is. They believe that it's kind of a top-down process where data just gets thrown into a hopper and there are all these real strict black and white rules that you follow as an accountant, and it's more of a pencil pushing process of just spitting out these financial statements according to these very rigid rules. So very dry and boring type of activity. But really that's very far from the truth, because for one thing, a lot of the accounting is now being done, the day-to-day kind of drudgery type of accounting is being done by computers. So what we're really interested in accounting is that we are using all of the activities of that business, and we're putting those into a format using our critical thinking and accounting judgment to produce good, useful, relevant information that can be used by the managers to make decisions. So actually there's a more of a circular flow in accounting where we want the managers to have make good decisions that will ultimately impact in a positive way on society and increase our economic activity. So all managers at some time in their career are going to face ethical decisions or ethical dilemmas, and accountants definitely will face that. Within managerial accounting, there is a certification called a certified management accountant that is offered by the Institute of Management Accountants, and that is just going to show that that accountant has expertise in managerial accounting. And as part of being a certified management accountant, you are expected to uphold certain ethical standards in order to be able to maintain your certification. So, for one thing, if you become a CMA, you have to be able to maintain your professional competence. So, that's going to involve getting continuing education so that you can stay up to date on things that are changing within the managerial accounting profession. Also, because management accountants have access to so much information that is so proprietary to that company that could be used by competitors against the company, it's very important that certified management accountants understand the need to preserve confidentiality of any of the information that they are privy to in their jobs. Also, anytime that you get a certification, you're expected to act in a professional manner. And part of acting as a professional is that you have integrity and credibility. So, because we do know, or because the IMA understands that certified management accountants will face these ethical dilemmas, they offer suggestions on how they can resolve ethical problems that come up. So, the first thing that the IMA suggests for all management accountants is to first go through your organization's established policies. What does your employee manual or employee standards say? How should ethical dilemmas be resolved? So most organizations now have ways for people to report any fraud, waste, or abuse that they know is occurring through anonymous fraud hotlines. So that is one way if the employee feels like there could be, they want to remain anonymous and not have to reveal who they are. Unless your immediate supervisor is involved in the ethical problem that you're having, you first need to, of course, discuss it with them. That may be the best thing and may resolve it right then, especially if it's some type of conflict of interest that you are involved in personally. Maybe you have a spouse that may be employed with a company that does business with your company, and it might create a conflict of interest, and you may be able to resolve that just by going to your immediate supervisor. But let's say that this ethical dilemma that you're involved in or that you know about involves that supervisor, or else your supervisor has not been able to help you to resolve it. Sometimes it helps to go to somebody who is an objective third party, so someone that's not involved in the situation but has some expertise or can provide you with some advice on how to handle it. Of course, if it's going to involve some type of legal liability, you need to consider whether or not you need to discuss it with an attorney. So, of course, if it's going to involve some kind of breaking of some kind of laws, and you know that the ethical problem could involve some type of criminal problem, or even if it could involve you losing your job, then sometimes you need to get an attorney and discuss it with them. And this is the conclusion of the demonstration for Learning Objective 1.